Government bonds are one of the safest asset classes you can invest in. They're known as treasury bonds or treasuries in the US or gilts in the UK. But it's wrong to assume that bond funds will never fall in value. Sometimes they do, and 2022 was a rare example.
We had a confluence of events in the summer of 2022 which had profound implications for investors and for bond markets and the gilt market in particular. So we had an environment that was defined by rising inflation and rising interest rates after a prolonged period of a moribund environment for government bond yields. But added to that, we had a UK specific shock around the mini budget and the new and temporary leadership in the UK, which saw gilt yields spike dramatically over a very short space of time.
But as a behavioural expert, Joe Wiggins says there's an important lesson to learn from what happened to bonds in 2022. It's this. As investors, we tend to focus on risks that are salient and recent and neglect risks that we haven't experienced before, or at least not for a long time.
For investors in bond funds or mixed asset funds where they've got significant allocation to bonds, we've been through a period of equanimity for gilts and for treasuries for such a long period of time where they've moved lower, they've been close to zero for a significant period. We haven't seen them as assets that can go through difficult and risky periods as well. And then we have a shock, and then we see very significant losses in certain areas of the bond market, and that comes as a surprise to us. So we need to be aware when we're thinking about risks and our own behaviour that things can happen in markets that we haven't experienced before, that are different to the common models that might be used by asset managers or advisors as well. So we need to be aware of our behavioural response to risk.
So what happened in the bond markets in 2022 doesn't mean that you shouldn't invest in bonds. It's simply a reminder of why it's so important to diversify.
Diversification is about our inability to predict the future. If we knew the future, then we'd invest in one asset or one security because we know it would be the strongest performing, but we don't. So we're diversified across assets, so we're able to withstand difficult and unexpected periods that we might experience through time. And the other point is that behaviourally we need to be prepared for any investment strategy to go through difficult and challenging periods. So even if a strategy we're investing in has been very effective for a decade or more, there will inevitably be periods when it is more challenging. We need to be prepared for that and behaviourally comfortable withstanding those challenging periods, because generating high returns through time is about accepting some level of risk and behavioural discomfort.
And that's the bottom line. All investors are bound to feel discomfort from time to time. If you're diversified, there will always be parts of your portfolio that are performing less well than others. But by spreading your risk, you are greatly reducing the chance of things going badly wrong.